Welcome to the weekly update, where I'll go over the action in the market for the week of March 17th through the 21st, and we'll see how things look for the week of March 24th through the 28th. Okay, yeah, getting a little bounce out of this. What we're trying to decide is just a plateau that may produce some kind of a tradable bounce, meaning we'll have kind of a meaningful recovery, and then we hit some overhead resistance and turn and then go back down even more. Or is this something where we can hit a bottom, start to come up out of that, and actually turn things back more positive, get back above these moving averages that we've lost at the 20-day moving average and 50-day, and then see everything switch over and look positive? That's kind of where we're at right now. We did have a really quick downward move ever since the middle of February, and it looks like we're trying to at least improve on that now. We have at least slowed down. And in the process, though, it's doing a little bit of damage to our longer term charts, and things are still pretty much negative, but there are also some positive things to latch onto. All right, before I get going, please know that I do videos every day that you're welcome to check out. They're posted on YouTube and Rumble. I make them available right when the market closes. Now, these videos are actually designed to be viewed before the market even opens. And I'm going to be launching a program pretty soon where you can have immediate access to the videos. Then what I do is I withhold those. They're posted, but they don't go public until right at the close for that particular day. So for example, if today is Tuesday, I post the Tuesday video, and that's available many hours before the market even opens. And it's meant to be viewed either before or during market hours, but it doesn't go public to everybody else until right at the close. And if that's something that's of interest to you, feel free to send me an email or leave me a comment because I'm in the process of setting that up. And in the meantime, though, I do post videos every day. And so I look at different charts than what I look at in this video. We do more of a micro analysis of things to see these subtle little changes happening with the S&P 500 that you may find useful. I also am in the process of launching both a daily and weekly newsletter. Right now, it's free. If you're interested in that, post a comment, send me an email. I'll send you a link to the website that I have. For right now, everything is posted on a website through Substack, and you're more than welcome to check that out. Offer any feedback because I'm still in the process of working out the format and what's included, what's not included, how many newsletters are there going to be. When I finally get this thing up and going, it'll be $8 a month for all the newsletters that I post. I do have a PDF that's available in the description below this video and below every video that I upload. And here's the link. If you want to go directly to the website that I have right now, everything is hosted on Substack. That's where all the videos are. There are additional videos there that I don't post on YouTube or Rumble. And for right now, it's free. So all you need is an email address to register and check it out and see if it's something that you find beneficial. And then on the YouTube community tab, I update pivot points every day. There are some pivot points they'll will be changing here in April, but they apply for the whole month. I just updated with that day's particular bar. And then intraday, there are also pivot points, which are support and resistance levels. And it's just amazing to me just how accurate those can be and how helpful they can be as well. There is a private Facebook group that you're more than welcome to join. As I keep saying, it's not really active, not a lot of members, but if you want to come in and join, you could change that. And then as far as YouTube and Rumble comments, I don't get a lot of comments on my videos because I don't take real opinions in them. I'm just kind of saying this is positive, this is negative. And so you get people to say, I think this, I think that. It's like, okay, you're welcome to do that. I don't really do that in the videos. I just try to point out what I see happening, and then we reach a conclusion based on what we see there. And there's really no opinions. It's just a matter of interpretation at that point. But I do get rid of the garbage comments, the scam comments, the social media scammers that are out there telling you they're a genius and really they're just trying to sign you up for a program that doesn't exist. And I give an email address in the videos and they tell me how wonderful the videos are, but they post a comment instead. I say, please email me about this, and they don't. So that tells me they're not watching the videos. And so why should I even give them any regard at all? And then I do post on YouTube and Rumble as well. Okay, so let's go back and look at the week. For the week, we were up 0.51%. So for the first time in 3 weeks, we've actually had an up week. Volume was above average. Now, this is a little bit misleading because Monday through Thursday, volume was below average. It was Friday where we were way above average, so that bumped the weekly average up quite a bit. Friday was, however you call it, either quadruple or triple witching, where you've got all these options that are expiring at the same time. We're coming up to the end of the quarter, and that just produced a massive amount of volume, and that's why we were above average. But as we've been moving around, and just having more regular days, we're actually below average with volume. The market's just kind of teetering around, doesn't have an awful lot of conviction. There are people that think we're going up, there are people that think we're going down, and there are people that are just kind of stepping back and waiting to see what will happen. And in the meantime, they're just on the sidelines watching, and that's contributing to below average volume. And we are turning more negative with our technicals, and I'll go through and try to compare them with what we're seeing on the daily charts as well. Inflation seems to be under control. We had CPI, PPI coming out, and these were just recent reports that actually came in weaker than expected. Interest rates were down a bit from the previous week. And what's really bothering the market right now is, okay, what about the economy? Are we going to see growth in the economy? There are some GDP estimates that are negative. There are some other ones that are actually positive, and they contradict with each other. And then everything geopolitical going on, everything between Russia, Ukraine, things in Israel, all the changes taking place in the US under the Trump administration with Doge and the executive orders. That's producing a real upheaval now. The status quo is being ruffled, and that produces some jitters for the market. And there's this debate going on back and forth. Are we going to go into a recession? Are we not? There's a lot of charts, and there are additional videos that I post about that on the website where periodically I'll post something and say, okay, this is the evidence that we will go into a recession. Here's the evidence that we won't. And then we did have the Fed come out this past week. They didn't do anything with interest rates, but they made their statements. And I'll go through that a little bit more here in a moment. The trend is negative now. It's not confirmed, but we have the ADX, which is what I use to measure the condition of the trend, not whether we're going up or down. It's just if that line's going up, the trend's getting stronger. If that line's going down, the trend's getting weaker. And on the short-term daily chart, we're getting weaker. And then we're almost getting weaker on the intermediate term daily chart. Here on the weekly chart, we are actually getting stronger with the trend, but I'll show you the chart for that. And we're negative because the red line is above the green line. Okay, here are some comments, and I'm doing it a little bit different this time. It's a little more words. We'll see. If you have any feedback about this, please let me know. But there are ongoing concerns about economic growth. What's going to happen with the economy? Corporate earnings. Now, they're still looking good going out into the future, but they're not quite as good as they were before. They're being revised down. And it's earnings that ultimately drive stock prices. And if the earnings aren't there, you're not going to see stock prices going up as much. And that's why a lot of the mega caps and all the different stocks are really seeing their earnings, at least going out into the future, being revised down. And then the tariffs. And everybody has an opinion about that. It's a good thing, it's a bad thing, it's recessionary, it won't be recessionary. Well, anything that Trump does, I don't like him, so it must be bad, or I really like Trump, so it must be good. We just follow the evidence here and try to remove opinion and emotion from the whole process. But the market is concerned about this. What's going to happen? Is it going to be short-term pain, long-term gain? Will that eventually take us into a recession? But in spite of that, the S&P and NASDAQ were actually up on the week. It ended a 4-week losing streak. We were up about 0.5% with the S&P. And then the equal weight. This is kind of interesting. This is where we're seeing some of this growth versus value rotation going on. Because when you look at the weighted version of the S&P, that's the regular S&P 500, it's been underperforming, even though it was up 0.5%. But the equal weight version, that was up 0.7%. That means the rest of the stocks actually are doing a little bit better. And that's where we're seeing some rotation going into right now. And it's not just all going into the mega caps, the stocks that everybody wants to be in. Then the Federal Open Mouth Committee, they did meet this past week and they all voted to keep rates the same, which is at 4.25 to 4.5. And then throughout that discussion, what they've been doing, going back to June of 2022, when inflation kind of topped out and started coming down, first of all, they called it transitory, and it turned out that was not the case. But they're starting to take things off of their balance sheet because what the Fed does now that the market pretty much expects is something that the Fed used to say, "Oh, we'll never do that. That's not part of a free market capitalist system." Where they come in and the Fed actually buys bonds. That's called quantitative easing. And they to try to keep the economy alive during the COVID lockdowns, they came in and just started buying all kinds of bonds. Well, some of those bonds are starting to mature. And what do? Buy another bond at the end? Or do they just let it roll off of the balance sheet? And that's what they've been doing lately. About 25 billion a month has been coming off of the Fed balance sheet. That's why later on in the video, that's why we look at that Fed balance sheet chart. And you can see that it's been coming down. Well, now they've decided to slow that down a little. Instead of 25 billion a month coming off, they were going to slow it to 5 billion, and that will start April 1st. Well, Governor Waller dissented. He doesn't think that was the right thing to do, but everybody else said, okay, this is what we should do in that whole process. And then when the Fed meets, they come out with the summary of economic projections, a little report that the markets now become fixated on. And basically, what they did is they lowered their GDP forecast and they've raised their inflation forecast. It's kind of negative, lower growth, higher inflation. And we're going to be getting the core PCE report due out this Friday. And so that'll give us another take on what's happening with inflation. But when they also came out with their projections were what will be the interest rate for the Fed at the end of the year, and they have it at 3.9%. Well, we're at 4.25 to 4.5 right now. That means that interest rates are going to have to come down, and that means that there are probably going to be two more rate cuts. At least the Fed is anticipating doing that right now. This could change at the next meeting, but the market kind of like that there's still some rate cuts in the mix. They're not going to happen right now. And then when Chairman Powell has his press conference, these are just some kind of the points that were takeaways from that. He emphasized a cautious approach to policy adjustments and noting uncertainty about inflationary factors that were possibly going to happen because of the tariffs. Even they don't know. I mean, everybody can have an opinion about this, and somebody can be really dogmatic and say, yeah, this is going to happen, that's going to happen, but nobody really knows. It might be more damage in the short term, but over the long term, it could end up being a pretty positive thing. It may be a complete mistake from the beginning, or it may be just fine from the very beginning. We don't really know, but the market is unsure about that right now. And the market is weary of this because then other countries have said, we're going to put tariffs back on you, America. Those are reciprocal tariffs. And that develops into a trade war there. And this is all supposed to start around April 2nd. Okay. And then for the week, the 10-year yield closed at 4.25%. And I'm also including the 2-year yield here. It closed at 3.95% and actually dropped. Where a week ago, 10-year rates were actually a little bit higher. They were up at the 4.31 range. So for the week, the Dow was down 1.2%. The was up 1.2%. The NASDAQ was up 0.2%, S&P up 0.5%, and even small caps saw a 0.6% gain here. This is the chart that I've been showing every week now for a couple of years, and this is what the market's concerned about. We're still right about in here where I'm circling with the cursor about 1977, where the anticipation is that inflation would be coming down. Now, it's not coming down as much as the Fed would like. That's why they stopped lowering rates. But we're still considered to be in this. What the market is concerned about is what's going to happen after this. Are we going to go back up with inflation and then eventually get to the point of hyperinflation, or what we called it in the 70s, stagflation, super high inflation, but no economic growth? That's what happened then. And we're kind of tracking along what has happened before. The takeaway that I would get from this is that even though we're tracking along with this, this is just a projection. This doesn't have to work out the same way that what we're seeing in these charts. This is just kind of a guide to help us along the way. And there's a mistake on here. When we're above 4.02% with the 10-year yield, which we're at 4.25, I put the number in the wrong place here. This is why we're seeing corporate profits being revised down as far as future um, forecast, because when it gets above 4.02% with the 10-year yield, that's when, okay, now companies have to pay more for interest instead of that being profits that can go to shareholders, or it has to go in a different direction instead of being a profit. Then this was not updated. It's only updated once a month. This is when the employment report comes out showing that the last reading, we saw a tick down in those folks that are unemployed for 27 weeks or over, which is longer than 6 months. Then this is just kind of the exact opposite of what we were seeing in 2023 and 2024. Monday used to be a very good day in those years. This year, it's the worst day of the week. And Wednesday seems to be the good day, and Friday's in second place. Now, this will shift as we go throughout the year, but we're not seeing the normal things that were tending to happen over the last couple of years. And people think that the way things are now or the way that they're always going to be. No, the market shifts. There used to be a book out there that says never buy on Mondays. Well, tell that to the last couple of years when that was one of the biggest, if not the biggest, up day of the whole week. You would have missed out on a lot of gains if you followed that philosophy. Right now, that philosophy seems to be coming back, and Monday is the weaker day. And the aggregate financial asset allocation, what are households owning right now? And 51% is equity. And that's why folks need to have some education about the stock market. And I hope that I can be a part of that. I hope that some folks at least find some use in what I'm doing, even if they're not really involved in the stock market. I am an educator and I like to teach about this stuff. And so it's like whether you're in a pension plan, whether you're in mutual funds or 401k or Roth IRA, whatever, you're involved in the stock market. And so it's to your benefit to have at least an understanding of what's going on, because that's where most people are at. Where you have 19% that are in debt, those are bonds there. And then 14% is in cash, like money markets, CDs, things like that. All right. And then I included the description here. What they're taking away from this chart is they think that volatility is really going to come down, which means that could push stocks up when the tariffs kick in on April 2nd. And they're trying to figure out what's happening here with the VIX, which measures volatility. And they're really seeing that, okay, maybe things will get a little bit better. All right. And then this is just looking at the market cap of the largest stock relative to the overall market, the weight of the top 10 stocks here. And it's pretty high. And then U.S. dominance of global equity markets is waning. Well, lately, world markets have been outperforming U.S. markets. And you can kind of see that here. It happened during the election. Now, the people that hate Trump just use this as justify for more hate. The people that like Trump say, well, I mean, we're shifting things. There's 112 years, I think there is, 113 years of what President Trump considers to be damage done to the overall U.S., according to the Constitution and how the economy runs and so forth. And he's trying to undo 112 years of damage in a very short period of time. And that's going to produce some pain in the economy. Other people say, nah, he's a Nazi. Of course, anyone who says that doesn't even know what a Nazi is. And if they call him Hitler, then they have no idea who Hitler really was. It's just totally wrong. And then I love the one where people throw around the word fascist, try and then say, okay, you call me a fascist or I call you a fascist. Explain to me just what is a fascist. Most people can't even do it. It's just a word that gets thrown around. Anyway, so there are changes. And in the meantime, the US is going through some growing pains here. All right, now looking at the latest FactSet post, it says they're pretty optimistic on their ratings for companies, and there are different ratings out there on stocks inside of the S&P. In fact, there's 12,320 ratings on all the stocks, the 503 stocks that make up the S&P 500. And then what FactSet does is they say, okay, out of those ratings, 55.7 are buy ratings, 38.7 are hold, and 5.6 are sell ratings. Now, my personal take on this is all useless waste of time stuff because there's a lot of pressure that's on here. If you're an analyst, one of these if you're making one of these 12,320 ratings, and let's say you analyze Microsoft as one of your companies, and you call up you call up people and you talk to them, and they give you information about how their earnings are looking, and you maybe develop a bit of a professional relationship there, and they tell you things, and you can use that into your overall system. Well, what happens if some of the things that you find out about the company are not necessarily good and you all of a sudden issue a sell rating on, let's say, Microsoft? You don't like what's going on there. You see some financial problems or what have you. Maybe they haven't jumped on the AI bandwagon quick enough, and you don't think it's a good investment. Now, do you think if you contact your folks at Microsoft and try to get more information, that they're going to accept your phone calls and respond to your emails? No, you're bashing the company by giving it a sell rating. So you basically have been blackballed, and I'm just using Microsoft as an example. You've been blackballed by Microsoft, so they're not going to give you information anymore. So now you're under pressure to say, okay, maybe I better come in with a buy signal so they'll still be nice to me. Or maybe at worst, a hold rating, which a lot of hold ratings can pretty much be sell ratings at that point. And then the thing that really gets me sometimes is you watch the financial channel, especially CNBC. People live for these people that come on that are supposed to be experts, and they say, "Yeah, we're suggesting you buy that, you buy this. We have a buy rating here, buy rating there." Well, I don't know how many times I've seen a stock that, let's say it was at $100 a share, and then it goes down to 90, 80, 70, 60, 50, 40, 30. And then when it gets down to like 10, then the company comes out and says, yeah, we're issuing a sell rating now. It's like, where were you 90 points ago? You guys are supposed to be watching this stuff and giving me some insight about whether I should buy more of this or actually get rid of it. It's not doing me any good, and so that I don't buy into this, but there are a lot of people that do, and they're still mostly seeing buy ratings, and we're actually seeing that going up, and that could end up being positive. Okay, what are they citing on their earnings calls? Actually, it's coming down and not all that through the roof when we look at the number of times that companies mention inflation. And we're seeing that in some of our other charts. If you watch some of my other videos, the market, there are areas of concern, but when people say I'm worried about inflation, well, it's not really being reflected in the market. There are some areas we're seeing like the CRB index going up, and there are some commodities that are going up that could be inflationary because as their price goes up, that'll eventually bleed through into prices like for corn, wheat, oil, the things that we need to buy to live. But they're not really talking about it all that much in their earnings calls. And we're actually seeing it going down here when we look at the little longer term look at how many times they're using the word inflation. Okay, so here is their intraday chart going back to Monday. Had a nice little run up into the close there. Then Tuesday came along and we gapped lower. But what was interesting about this is we set pretty much the low right after the open because we came down and then boom, just went sideways after that. There was really no conviction. And then on Wednesday, this is when the Fed met. And we did see a nice little bounce after the Fed meeting. They liked what Jerome Powell said, and maybe the idea of two rate cuts in the future. They liked that. Then on Thursday, we actually gapped lower and tried to take things higher, but we pretty much topped out at Wednesday's high and then came down after that. That's more negative, but we did see a little bit of bounce going into the close. That's what I really watch because this is when the smart money comes in from about lunchtime on Eastern time. That's when I really focus on, okay, is there buying or selling going on here? And then Friday, we actually gapped lower, but this looks a little bit more constructive because we set the low right at the open and we closed right at the high. But this was options expiration, and it's kind of its own crazy day anyway. It's a little hard to determine whether we can read a lot into that or not. Then looking at this for the 5 trading days on the week, we had the Dow was up and all the other indexes were down. Now the S&P was up, but that's on a Friday to Friday basis. What I try to do here is measure this a little bit different to give it some perspective. What just took place during the week itself, where all the other indexes ended up being negative. Then going back to the beginning of 2025, we have the NYSE. That's actually holding up the best. Now it's been getting hit too, but not hit as hard as some of the other indexes, especially the small caps and the mid caps and the NASDAQ. Everything else is negative year to date. Then the different sectors. We had an up week, so I sort this according to what was up the most. Energy. That's a little concerning because that tends to be defensive. We liked that the financial sector came back. They were seeing some weakness, and we watch the financial sector. We want to see, is there going to be another great financial crisis like we saw 2007 into 2008 into 2009? Yeah, that was not a good time. So we keep an eye on that. We like that that's doing better. Healthcare is also more defensive. One thing that's encouraging, though, is that communication. That's a growth area. We want that to do well. We want discretionary to do well, and we want tech to do well. And we're also kind of encouraged that staples were down. That's defensive. That's toilet paper and toothpaste. And that ended up being down for the week. Then on the next chart, I sort this on a scale of 0 to 100. We have energy looking the best. Now, even it's not looking great. It's at 89. When it's really looking good is when this gets into the 90s, and we don't have anything there. The financial sector is also looking pretty good now. And then communications in the mid 80s. And then down at the bottom, we have discretionary. We want that to be doing better. Tech, that's the big driver of the market. It's coming in 11.5. So some of these areas, these growth areas, have not been doing all that well lately, and that's why we've been taking a hit in the markets. Then this looks at the sectors for the 5 trading days. We had energy up the most, followed by financials. That's good. Communication and discretionary. These are two growth areas. It's good that they were up. And then it's good that staples were down if you're more positive on the market. And then going back to the beginning of the year, why is the market lagging? Why is it having difficult times right now? Discretionary and tech are negative year to date. Now, communication is up here, but it's doing okay. It's a green right here. It's doing okay, but it's not leading. We need these three areas, the green, the pink, and the blue. Those need to be over on the left-hand side and outperforming everything else. That's when the market is really going up. Then looking at the relative rotation graph, the strongest areas are up here in green. There's not much. We're seeing communication is doing okay over the last year. Financials are showing a little bit of strength. So those are the more positive areas. But then we look at discretionary, which was really strong. It's yellow and going down. That's negative. And then we look at tech, which is red. That's even more negative. At least yellow is caution. Red is outright negative, and it's going down as well. And we're seeing some rotation going on here as we're seeing this switch from growth over to value. And that's what the market does when it's getting more defensive. And looking at more in a spreadsheet type format here, we have the financial sector and communication. Those are green. Yellow is discretionary. Red is tech. And then the other areas that are showing some improvement are the ones that are in blue, but they haven't actually turned positive. They're just looking a little bit better. The different indexes. The S&P is the one that's holding up about the best. That's because it's made up of 503 stocks, and there's growth stocks in there, and there's value stocks in there. That's why the advanced decline line's holding up fairly well. It's not coming out of the S&P. It's going from one part of the S&P to another part of the S&P. And so this has been holding up a little bit better. Where we're taking a hit are in the big stocks, the S&P 100. That's the OEX, the NASDAQ 100. People love the NASDAQ 100 when it's going up, but when we're under pressure, it goes down faster too. And then we are seeing some improvement with utilities and then the Dow Jones Composite Average, where we have things like the transport, small caps, and mid caps. They're really languishing right now, not looking all that solid. Then here we go with the S&P looking about the best right now, according to this measure over the last year, where we're looking a little bit more cautious with the S&P 100 and NASDAQ 100. We're more negative with the mid caps, small caps, and transports, and we're seeing some improvement with the composite average and utilities. All right, then sentiment. We're still camped under this 25 level. If you go back down here and look at this, usually when we get down here, we come down, everybody freaks out. It ends up being a market bottom, and we V bounce up out of that. That happened here about a year ago. We had a nice little bounce up from there. Then we had another downward move down below 25, bounced up out of that. We came down below 25 this time, and we're just camped down here. That pretty much fell back in February, and we've just been sitting here. It's not working the way it usually works. We use this as a contrarian indicator, not status quo type of a thing, meaning that this usually doesn't last very long. Now it's been lasting a long time. Active asset managers, pretty much neutral now. If they're above this red line, that's a lot of buy signals. Down below this blue line, that's a lot of sell signals. And they came in with 64.64. Currently, we are dropping down. Wednesday, Thursday, and Friday for the first time in a while. We've actually closed below 20 with the VIX. When we're above 20, that's negative. That produces negative annualized returns. When we're below 20, that's when we get positive annualized returns. And so the fact that we're back under this blue line is encouraging. It would be even more encouraging if the VIX continued to fall. And we're also seeing that with the line chart. That's the closing value. And then the bar chart is the open, high, low, close for the week. This is looking a little more negative now. When this black line is going down, that means the tech sector is outperforming cash. When this black line is going up the way it has been, that means cash is actually outperforming the tech sector. And we're coming up into this red cloud. Now, we've done that before, and this is 2022 when we actually went above the cloud. But this is also suggesting the market is becoming more defensive. It could turn and come back down, and we could recoup out of this. But in the meantime, what we see here is a little bit of caution for the market. And then this is the RIDEX bear bull ratio. When this spikes up, folks that get into the RIDEX mutual funds, they have one that you can get into when the S&P goes up, and they also have one that you can get into when the S&P goes down. When I started the program that I now teach, that's all I had available to me were mutual funds. Now I do most things around the SPY, which is the ETF for the S&P 500. But we can see a real spike up here as folks were getting into the bearish fund as we were going down, and they're still giving a pretty high reading. Then I think it's the third week now, the individual investors are giving an extreme negative reading. That's another one. When we see these blips down below this 30 level, it's actually minus 30 level, this usually is like a market bottom. We come down here, get into this area once, and then come up out of it. We're coming down here and camping here, just like we're seeing with our sentiment gauges currently. Very different than what we usually see from these indicators. And the ulcer index, that's another fear gauge. We're coming up above the moving average. We're getting a very high reading, even though it's declining on the daily chart. But this is showing longer term. Fear is increasing. This ulcer index is just another sentiment gauge. We're keeping an eye on this, the spread between risky and not as risky bonds. Now, risky bonds would be junk bonds, and not risky bonds would be government bonds. They're considered to be very safe. When this starts to go up the way it has been, that means there's more fear coming into the bond market. So I use it more like a sentiment gauge. Now, this next chart is, I inverted what you just saw. So when this is going down, that means fear is going up. Well, we've been backing back off a little bit here, but this has been dropping, and this is causing us some concern. Not because we're worried about the bond market, we're worried about what's the sentiment of the bond market, Because if the bond market's not happy, then the stock market is probably not happy. Or there are times when we want the bond market to be unhappy because the stock market is happy and vice versa. But we just keep an eye on this more from of how are things feeling at this time. And then we look at the VIX, which just measures where the VIX at right now, and then the 3 month average of the VIX. And when this is going up, that means in the shorter term, volatility has really been picking up. And then this is a 253 period equity put call ratio moving average. This is still going down. It's leveling out. It has not turned back up yet. If this does turn and go up, that's going to be more negative. You can see when we were really coming down here, that's when the S&P was going up. When we got into 2022, which was a bear market, this thing was really going up here. So this going down has been positive longer term. If it does switch gears, that could turn more negative. Then the latest reading of the Chicago financial conditions, we're still below the black line. And that means everything's okay. When we get nervous is if we go above the black line and we're not there. And here's the Atlanta Now GDP estimate. And people that hate Trump are pointing to this one, saying, well, yeah, you come in here and now they're going to have negative GDP and so forth. Well, that's the Atlanta Fed. But if you're in the New York Fed, you go, yeah, this one, we're coming in at 2.72 positive. So as I've been saying through these videos, it's like you think that these folks would email each other and say, I'm getting a positive result for my forecast. And then Atlanta says, I'm getting a negative forecast. Well, shouldn't we talk about this and see why we're coming to different conclusions? No, it doesn't work that way. That would make too much sense. All right, then this is the GDP now out of Atlanta showing that there is a negative forecast. And then this hasn't been updated. We're below the red line. That's positive for right now. This is updated when the employment report comes out. This hasn't been updated, but it looks about the same as where we're at. If we get above the black line, and really if we get above the red line, we will be concerned about going into a recession. We're not there yet, according to this chart. We're also coming down with this. This is a quarterly report that's not updated as often. And the fact that this is coming down is a good thing because other times when we go up with this, that's often when we go into a recession. Then inflation, we did adjust here a little bit for CPI that came out. We're going to get PCE core coming out later in the week, so this might adjust, but we're pretty much level there. And then as far as now we're done with the March meeting. We don't have a meeting in April, and so the next meeting is now in May. There's about an 86% chance that when they meet May 7th, they're going to leave rates where they're at right now. And then okay, I thought I fixed this, but apparently there's a mistake here. And then looking at the June 18th meeting, that's the next meeting after this, there's about a 67% chance that they're going to cut rates at that meeting. So folks are anticipating things changing between that meeting. And then this is the next meeting out here. They're kind of locking that in. This dark arrow or dark bar here, that's where it is right now. And then we go a day ago, a week ago, and then a month ago. And the market's becoming more convinced that rates are going to be changed at the June 18th meeting. And then we keep an eye on the Fed balance sheet. This is what I was talking about, where things are bleeding off the balance sheet. And this has been the rate that it's been going down. And they want to lower that rate of things falling off. But except for that one Fed governor that said, no, let's keep it the way it is now. But we should see this not go down as much as we've been seeing it before. And then just to keep an eye on this, this is the year over year look at the Fed balance sheet where it's actually been going up back up a bit. And then we keep an eye on this, but we're not really seeing any warning signs with the overnight reverse repurchase agreements. If this really starts to spike and go crazy, this might mean that something weird is happening with the banks. And really, we're not seeing anything all that concerning currently. Now, looking at the charts here, this is where the advanced decline line has still been holding up fairly well. And that's because we're seeing rotation instead of money actually coming out of the market. We're still above the moving average based on price and volume. And we're seeing more of an improvement. We're actually turning more positive on the daily side. We're starting to go back up with our moving averages there. We're turning up a little bit here with the 4-week moving average, but we're still declining with the 10-week moving average. but a little bit of an improvement after it had been weakening, showing that there were no more new lows than new highs. And this is kind of interesting. The last few weeks, we've been going down and the advanced decline ratio has been going up. And then we have an up week, and so the advanced decline ratio goes down. Figure that one out. But it's how it's calculated. We're still above zero, though, but it did come down just a little bit. And there's a 19-week and a 39-week moving average of this advanced decline ratio that I show. This is the trend that is still negative. Now, the ADX that I've talked about previously in the video, that's the black line that you see here. When it's going down, that means the trend's getting weaker. When it's going up, that means the trend's getting stronger. Doesn't tell you positive or negative, just the condition of the trend. I put a moving average on here to give it a little bit of context. We're above the moving average. That means we're going up. That means a strengthening trend. But I use a moving average because it's dynamic. It goes with the ADX. Wherever the ADX is, the moving average is not far behind. Well, there's a static level here that some folks use. And when this indicator was originally developed, they suggested something like 25 or 30. I have found over the years, I use a level of 20. And when we get above 20, that means we're in a confirmed trending environment. And we're not there yet, but we are in a strengthening trend environment, and it's negative because the red line is above the green line. That's where we get the positive and negative from on this chart. Then the Arun indicator, which tries to measure the difference between buyers and sellers. Buyers are green, sellers are red. It really went up with the red, and so we're dropping down below zero here when this measures the difference between the two. The mass index here on the weekly chart is not generating a signal. We're watching for a signal to be completed on the daily side. And when that happens, that suggests a reversal. And we've been coming down lately, so that might mean a bounce. But we haven't had that signal yet. This is the daily chart showing how we're underneath the 200-day moving average. We're going to need to get that back to turn things back more positive, and of course get even more positive if we could get back above the 50-day moving average. And you see this huge spike in volume on Friday, where for most of the days last week we were below average with volume. Then this is the long-term trend channel going back to 2009. And we saw this coming. And even back in December, we started hitting the upper end of this trend channel. We set a new all-time high at that time with the S&P, and then back in February. But it's like once we get up to this level, that's where things really started to stall out. And now we're coming back down. What we're trying to figure out here is, are we going to bounce back up or are we going to continue to go down? And this is also positive for right now. This is another weekly chart of the S&P with these pivot points that are on the chart ahead of time. And we're still above this pivot point. We were able to close above it a week ago. We're able to get above it this past week as well. So this is longer term support that is still holding for the time being. Now we're seeing a hit here with the 50-week moving average coming all the way down to this red line here, but we're still going up with the red line. If we break below this, yeah, it's going to be more negative. Maybe we'll bounce up off of it. They can use it as support. And then we look at the long-term trend. We're still battling to get back up above the 200-day moving average. And then, excuse me, this is a 50-week moving average, which equates to about a 200-day moving average, not quite 250. Then looking at the smart money indicator, we're still above an advancing moving average. That's positive. That means the smart money is coming in and actually doing some buying. They're just not buying the same stocks that really drove the index up. But we're negative here with the chicken money flow. This is smart money indicator number 2. Even though it's green, it's coming down and the red line's going down. Now, we did bounce back up this past week, so we're seeing an improvement. But unless we really see a positive week, we're going to continue to go down with this red line, which means negative. And we're also bouncing back up, but still overall negative with our third smart money indicator, the chicken oscillator. The vortex is negative with the red line above the green line. We're below the midpoint with the McClellan oscillator, even though we bounced up a little bit. And we're right about at the midpoint with the summation index based on price. And we did come up a little bit, but we're back to the midpoint here based on volume. That just shows a market that's really indecisive right now, not really leaning one way or the other. Looking a little more positive here with the Sunderland Trading Oscillator, we crossed back above zero based on price and volume. That's encouraging. And seeing a little bit of a bounce up here with the bullish percent index, which is also a little more encouraging. But we're dropping below zero here with momentum. We're still negative with the PMO. We're going down here. We're dropping below zero based on price and volume. And then the PMO studies are just about at the midpoint right now. However, we are seeing a little bit of an increase here with the buy signals, and we're flattening out after declining with the PMOs that are above zero. Now, this is the PMO. It was developed by a gentleman named Carl Swenlin. And then what he does is he takes PMOs for all 503 stocks inside the S&P. And that's what you see right here. What percent of those PMOs inside the S&P are going up? And it's just about at the middle. Which ones are giving buy signals, showing a little bit of improvement, and which ones are even above zero, and that is actually flattening out. Then we look at Bollinger Bands. This could be positive too. A week ago, we closed below the lower Bollinger Band, and we just barely got back above it this week. You can see this was the end of the world day. This was a pretty significant bottom here. We bounced up out of that. No, this was the low we set in 2023. This was the end of the world day here. We never even got to the lower Bollinger Band before we bounced. But we don't see this very often. And usually when we see readings like this, they end up producing tradable bottoms where, at least from this angle, we could come up out of that and that could end up being positive. Now, what we're going to be watching if that happens is is are we going to switch back over to a more positive environment by getting back above the 50 and 200 excuse me, 50 and 20 period moving averages, or are we going to hit those and then turn and start to go back down? And I've been mentioning that over and over because we have to look at the context. We might start to bounce and have some really nice up moves from here, but that doesn't mean that everything's switching back positive yet. We could hit a point and turn and go the other way. All right, then when we look at this on the weekly chart, we're negative across the board in the short, intermediate, and long term. Now, on the daily side, we're positive on a momentum basis in the short term. We're improving and starting to turn positive in the intermediate term, where on the daily side, the long-term charts are still negative. And we're positive on the daily side with the copy curve. We're still negative here on the weekly chart of the copy curve. And we're negative with the force index. We're negative with the money flow. And we had an up week, so we're slightly above the midpoint with the rate of change week over week. But we're still seeing overall declines here with the 50-week rate of change. And we're extreme negative with the Stochc RSI. On the daily side, we're extreme positive. It's the only one of our short-term indicators that's giving us that right now. But that just shows you how touchy this indicator can be. Now, this can stay down here for a while, but since it's extreme negative, that could end up being positive. And we're right at the midpoint with the ultimate oscillator. We're still below 50 with the longer term RSI. We're also still negative on the daily side. I use an RSI 9, that's 9 days, and then an RSI 14 days. And then I switch it over to 14 weeks here on this chart. All of them are still negative. They're all below 50. And the Williams percent are ticking up a little bit, not getting too strong a reading on the daily side, but seeing a little bit of an improvement here on the weekly side. And we're negative on the special K daily chart. We're positive still here with the weekly chart. And then coming down below this 40-week moving average here, if we continue to fall, I'll extend these lines out because they may really come into play. This is very, very long-term support, the 200-week moving average. That's where we bottomed back in October 2022 and then came up out of that. So, but we're far away from that at this point. But if we continue to fall, I'll readjust these lines. Then we are negative on the weekly chart for the Heiken Ashi. We're negative but pointing up on the Kegi chart. And we're negative with the Renko chart, and we're negative with the three-line break. So the weekly trend is more negative than positive. But we did see some new X's drawn in here. Nothing to generate a new signal. When we see O's, that means we're going down. When we see X's, we're going up. And we had 3 green new ones there with the bit of a bounce that we saw this past week. And the ease of movement, pretty much seeing the same thing on the daily side. Below zero and trying to improve, although this is a 14-week. And this tries to measure the path of least resistance. Well, lately, the least resistance has been down. If we get back above zero, that would mean the least resistance is back up. And longer term, with our momentum studies here, going down in the long term, negative in the intermediate term, negative but bouncing back up in the short term. We are negative with the Elder's Impulse system for the S&P, and we're negative with the parabolic SAR. We switch back over to positive on the daily chart. So it's a bit of a mixed signal here. And this hasn't changed, it seemed like, for a long time. I don't know if somebody's not updating this chart or what. This comes from stockcharts.com. We are negative in the short and intermediate term across all the different indexes that we follow. And we're still positive with bonds in the short and intermediate term, where commodities are negative in the short term. The dollar's been getting hit a lot in the short and intermediate term as well. And then I just look at the S&P on top, and then compare it with the mid caps, which have been underperforming, and then look at the small caps, which are even underperforming more than that. I don't put any studies on here. I'm just looking at price action itself to get an idea of what's been happening. And then the Dow, it was the last to give up its 200-day moving average on the daily side. It's close to its 200-day moving average now. We're wondering if it's going to be the first major index to get the 200-day moving average back. That could be positive. In the meantime, we're down here at the lower end at the 50-week moving average, which that does equate just about to a 200-day moving average. And then we're seeing a little more weakness here with the NASDAQ weekly chart underneath the 50-week moving average, as is the NASDAQ 100. The mid caps way under, and we're coming down here longer term. The blue line's still above the red line, but if things don't improve, that could change. And we're actually going into a downtrend now on the daily charts with the small caps. There are two indexes that I follow on the daily side. The S&P 600, that's crossed negative. That's produced a death cross. That's in a downtrend now. And then the Russell 2000 small caps, which is really close. It hasn't quite been triggered yet, but it's getting there. And we're seeing more weakness here with the small caps. Then this is a daily chart of the Wilshire, still below its 200-day moving average. The NYSE has actually been holding up about the best. This is back up near its 13-week moving average. And on the daily side, it's holding up a little bit better. It's negative, but it's looking better than the other indexes right now. And then all stocks, that takes US and world stocks together, taking a bit of a hit now because US stocks have been underperforming world stocks so far in 2025. The FANG index, this is another index for the really big companies, Facebook, Apple, Amazon, Netflix, Google, Nvidia. This is actually holding up fairly well, above its 50-week moving average. ARK, though, it's coming down with everything else. They own a lot of Tesla, and Tesla's been not doing so well lately. Plus, folks are trying to burn them up and put paint on them and do nasty things just because they own a Tesla. I mean, that's terrorism. But anyway, coming back down to its 50-week moving average here. We're holding up a bit better with the banks. This is what we're watching. We don't want to get caught off guard in case we see any clues of weakening in the financial sector. That's what led us into the great financial crisis. And yeah, it's been getting hit with everything else, but things are still not falling apart here. And then a seasonality chart, we're going back to 2021. We're up in March 80% of the time with a return of 1.9%. So far, we haven't lived up to that in March. And then looking at just another shot at the Dow, which is down, but holding up a little bit better. The transport's not doing very good. They're actually going down faster than the Dow is. And the utilities have been kind of chopping along sideways. They've been holding up a little bit better. Then the broad market. This is the CRB index, and this is a weekly chart. And we're going up on the daily charts, and we're going up here on the weekly chart. And that's producing some inflationary concerns because all these different categories over here, those prices go up. That means that people are going to have to pay more for those things. Oil has actually been behaving from a perspective of it's not going up. It's into the mid or upper 60s now. It got up into the 70s, but then dropped back down. Copper. Now, this is another barometer of the economy. And you need copper to produce industrial things. And so if companies that produce these industrial things think that the economy is going to get bad, they wouldn't be out buying copper to make new products. And so this is actually showing confidence going forward in the economy when this goes up. And we're also in an uptrend on the daily chart, and we're coming back to almost an all-time high here. So that could end up being good. This is not flashing any economic warning signs currently. The dollar's been just chopping all around here. It was doing really well. It likes those tariffs, but then everything started going crazy and the dollar has really dropped. Gold just setting another all-time high here. That's where people flock to in face of insanity. And silver is not at an all-time high, but still in an uptrend. And then we keep an eye on the price of bonds, and they're holding up fairly well. They are in an uptrend. And then we look at a monthly chart of stocks to bonds coming down, and for the first time in quite a while, possibly dropping below the blue line. This is a daily chart of yields when they've been coming down and now they seem to be stabilizing, if not actually going back up a little bit here. And this is a weekly chart, and I've been trying to point out this red line, that's the 10-year yield in Japan. But nobody seems to really care about that right now. With this going up over 1%, that's what freaked everybody out last summer. And so as this has been going up, I've been warning, is that going to produce a similar kind of problem to what we saw back in August? Well, so far, it's like nobody seems to care about that. All right, then some relative studies here. We have gold year to date performing the best, followed by the price of bonds. 2023, 2024, even back to 2022 were just horrible for bonds based on price. They're actually positive year to date. We're in third place, you have oil, and that's negative. We're below zero there. And then you have the dollar, and in last place right now are stocks. And then we look at the ratio between the NASDAQ 100, which is growth, and then the S&P, which is growth and value, showing how the NASDAQ 100 is underperforming the S&P. Both of them have been getting hit, but the NASDAQ 100 has been getting hit even more on a relative ratio basis. And then the biggest stocks that make up the S&P are starting to underperform the rest of the S&P, but longer term, the biggest stocks have been leading. Growth to value. We want growth to outperform if we're going up. If value outperforms growth, that usually means we're going down, and we're seeing a big pullback here, but not enough yet to change the overall long-term trend. Gold has been going up as stocks have been going down. That's why we're seeing this ratio going up. And bonds starting to cross above this red line. For years, we see how bonds have been underperforming stocks based on price. Now we're starting to see bonds outperform here. And that could be an overall shift. But this changes what we've seen over the last couple of years. Even in 2022, we would chop above and below this. And then we ended up going down as stocks were going up. And then we look at gold to the dollar. The dollar's been going down, gold's been going up. Surprise, surprise, this ratio is going up. And then low volatility. These are the defensive stocks. They've been really underperforming the S&P, but look at what's happening now. They've been outperforming. This is what we're watching longer term. We're also watching this on the daily side to see if we're seeing a switch over more to a defensive type posture in the market. Discretionary to staples. We need discretionary to outperform in a positive market. This coming down is more negative. And then energy has been outperforming tech. You can see longer term, energy's been underperforming tech. Lately, it's starting to bounce up. That's more of a defensive move, and that points for things to go lower from here. And watching if we do get a bounce that we might hit some overhead resistance before we turn and come down. But that could all change. If we start to go back up, things could switch back. These ratios could start to change, and we could go back to a more positive environment. Now, this chart, small caps have been getting hit, tech has been getting hit, so we're just kind of going sideways with this ratio. Then long term, the NYC breadth thrust, not really getting anything positive there. We did see a little bit of improvement here with the ZWAG NYC breadth thrust. We're not seeing a signal. We have to go below the blue line and then get above the red line quickly for that to be a signal. But we are seeing a little bit of an upward thrust here, which is positive as the market's trying to bounce up a little bit. And then this is a long-term trend line, a weekly chart for the S&P going back to the 1987 crash. Even though we've been coming down, we're still above this line. This is a shorter term look. And I'll extend this out if we get down here closer, but you can just see that we're still above the line. This is the Zohorchak method. It's still giving us a full buy signal. That hasn't changed. Now, this could change soon, but it hasn't changed at least to this point. And so this is still longer term positive. We don't get many signals or changes with this. And then we look at the new highs, new lows on the NYSE, and then this red line is a 50-day moving average of that. We're dropping below zero. So the NYSE is holding up, but it doesn't mean it's all rosy there either. We're seeing some internal weakness longer term. And then we're seeing some more weakness here. This is a trend line going back to 2009 with the NASDAQ weekly chart. We're dropping further below the red line. We need to come back and get above that if we're going to be more positive. And then the same idea with the S&P. We look at a 50-period moving average of the new highs minus the new lows. They're declining, but we're still above zero there. Where on the NYSE, we've actually dropped below zero. And then here's a ratio: growth, NASDAQ 100, value, the Dow. I know it has NVIDIA and Microsoft in there, but this ratio is holding up fairly well. I'm not seeing a real catastrophe there. And then we look at the Qs, growth, and then small caps here. And it's not that the Qs are doing well, it's that the small caps are just not doing very well. So we're well above this blue line here with this ratio. We want to keep an eye on the 3-month yield because this is where it started to fall apart when we went into the great financial crisis. So far, we're behaving okay for the time being. And then we look at a cumulative new high, new low for the NASDAQ. It is turning back down after it had been bouncing back up. That's more internally and a little bit longer term for the NASDAQ. Seasonality, March is supposed to be good. We usually are up 65% of the time. Now we're not done with March yet. It could improve. And we get an average return of 1%. And then the best time for stocks is from November to April, where we're up 77% of the time with an average return of 7.1%. And here's the second half of March, which should underperform the first half of March, but the first half of March was terrible. So let's hope the second half outperforms this year. And then the whole first quarter after an election tends to be pretty difficult. This is a composite where we're actually down here. We're probably way down here now. This chart hasn't been updated in a while. This just takes the 1 year, 4 year, and 10 year cycles and puts them together. And we start off kind of in a rough period before we have a tendency to break to the upside. We'll see if that ends up happening this time. And then, according to Carson, the second half of March should be better than the first half. Can't do much. There's not a low or not a big stretch for that to happen. And then here's a Hindenburg Omen. If you don't know what that is, here are the 3 criteria right here that are explained. And then this is the chart of that, and we're not seeing the confirmation spike at least yet. Now, the perma bears treat this as a done deal. Anytime we even get close to a spike, it might not even be a spike. At least the one guy I follow, he's just salivating, just sure that everything's going to fall apart. The one thing that's kind of weird, though, is that, and this is a little scary because about a month and a half ago, right around the middle of February, the perma bear that I kind of pay attention to, I get the emails and I read through the headlines. A month and a half ago, when I got the email, this perma bear was actually turning positive. We ended up just tanking after that. Well, now the latest email that I saw says that we could see a reversal after we've been declining. That scares me a little bit. I mean, I use these folks as contrarian indicators. When they're positive, I'm negative. When they're negative, I'm positive. But I dismissed this for a long period of time because it's perma bears that love this thing. But then I went back and I looked, okay, when were the other times that we saw multiple spikes? This is right before the COVID crash, and this is right at the end of 2021. So far, we've seen some single spikes, but we have to have another spike by March 31st for this to be valid. It hasn't happened yet. And we're getting closer every day, naturally, to March 31st. So we'll have to see how that plays out. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.